The housing market in Canada, Australia, New Zealand, and a few others barely took a dip during the housing crisis. It was a breather and escalated way beyond that. Home prices in the US came down significantly and allowed the restoration of sanity to temporarily resume. Since the financial crisis, we have witnessed historically low interest rates, which will absolutely keep this bubble going. But what happens when the rates go up? You came here for the truth, so let me unveil that for you. Today we are going to have our focus specifically on real estate prices. I will show you the indicators we need to look at that will spell it out for you. So let's get into it right away. As you see, fears of rising mortgage rates are about to become a reality, and some financial institutions have already quietly raised their discretionary rates, and potentially this is a harsh reality for Canadian consumers grappling with something I talk about all the time: near record debt. We had the subprime mortgage crisis, then we saw the whole housing market essentially in the US just come downward, and we saw other markets around the world affected by this as well. You saw Dubai and other areas where extreme drops in the price occurred, and that was all for a good reason because the prices had increased way too fast in such a short period of time. But then you look at areas like Canada, New Zealand, Australia, where yes, they did come down, but the price was so marginal, it was barely even noticeable. So what has happened since is that you see, yes, the US real estate prices have come up, but they had declined significantly previously. So you have a big separation now in between this appreciation since the years following the subprime mortgage crisis. What you have, particularly in Canada, is an extreme amount of debt. Consumers right now are at the most amount of debt they have ever been, and this can continue to some degree for the foreseeable future. I mean, you have record low interest rates. So what an individual does is they take the equity out of their home that's being built up because of low interest rates, and they are able to use it like a bank account. And that's what many people have done. This is full disclosure. It's not necessarily something that's kept or swept under the rug. This here is something that's happening within Canada, but it's a policy that applies mostly around the world, many countries in fact. So let's get into this today, beginning right now with Royal Bank hikes mortgage rates. They were not the only bank to do so. You see this also with the Bank of Montreal and CIBC hiked some of their mortgage rates, and they're doing so in fact in advance of the Bank of Canada increasing their rates. So the commercial banks don't have to wait on the central bank to increase rates at all. But should the central bank do so, it's obviously going to be something that snowballs. This is just a small amount. Of course, it's just the beginning. We can see that what has happened recently, the Canadian banks have suggested that they want to cool down the market a little bit because they say that, okay, we've overextended ourselves. We've increased interest rates a marginal amount to try and bring this back. But what they also do is they basically go through a stress test. So what they try to do is, yes, if mortgage rates increase to this percentage, then will you be able to afford it? And that's how they sort of try to determine if they're able to deal with it. Now, I don't think that necessarily any of it's real, because you can still see that people are able to afford homes at higher mortgage rates, and that is not true. Let's get into some of that as well today. This is a number that I discuss in my book, 11.7. Now, while that number continues to increase, even when I wrote about it in my book, it was actually quite extreme. What we're looking at is a house in Toronto cost 11.7 times the median total family income. Think about that. 11.7 times the median family income. Back in the day, it was said that a house was affordable when it cost 3 times your income. 3 times. So if the household income was $80,000 compared to now, where the household income is definitely in a worse situation. You have to figure that this ratio continues to get worse. In my book, I use the example of 1970, comparing that to most likely around 2010 or 2011 prices. And you saw that it was extremely bad. Now, it has gotten way worse since then. So they're saying some areas around Canada are not so bad, but look, the major cities are not doing well in this regard. Ottawa is saying that it's a little bit cheaper. Vancouver is much higher at 12.5 times. The whole point is that it's nowhere near realistic. Those in the financial industry, the realtors, everyone else, they're suggesting this can continue as long as more people buy homes. But you have a very, very fundamental point that's not being discussed. And I'll hold on to that thought for just a moment, because I'll be quoting that here. Almost 3/4, this is the big news of the day, almost 3/4 of Canadian homeowners would have difficulty paying their mortgage every month if their payments increased by as little as 10%. Think about that. Now, while this is only surveying of 2,000 homeowners, it's still significant. It's still very significant. 3/4 of people in Canada wouldn't be able or would have difficulty paying their mortgage just by a 10% increase. That right there should be setting off alarm bells. It's not. It's really kept on the down low. But this here, as far as I'm concerned, is huge. Such a small percent, which can happen at any time, is what will affect it. Now, Manulife is a very large company in Canada. The CEO of Manulife Bank said this: what these people don't realize is that we're at record low interest rates today. And that's the point I've made to you literally hundreds and hundreds of times. If we are at these very low levels, if it comes off, not even to, let's say, a high level, but just a historic average level, this would destroy the entire housing. It would bring the whole economy down. The only thing left in the Canadian economy is housing and the markets interconnected with that. This would destroy people. If mortgage rates increase by as little as 1 percentage point, some borrowers could be facing a hike of 10% on their monthly bills. 1% on their mortgage? Think about that. If somebody has a 3% mortgage today because they got in at the right time, they were able to get that 3% mortgage, or even better, we're looking at rates not that long ago of 2.5%. 2.5% moving up to 3.5%, that's historically very low. But all of a sudden, that's the 10%. This is so significant, and even Manulife, the CEO of Manulife, is saying, hello, we have a huge problem here. And what do they do to cool the market? Basically nothing. They are struggling to increase the central bank's main interest rate by 0.25%. They can't even do that. They're suggesting that this is going to happen at the next meeting. But, I mean, not even 0.25%. The rate is at 0.5% right now. It's basically free money for these banks, and just 0.25% is scaring them. That's when you know you have a big problem. But this bubble is going to wipe out a lot of people. The longer you continue, the euphoria that's occurring in real estate right now, and you'll see it in the comments of this video, is extreme in Toronto, Vancouver, other areas in Canada right now. And I know My friends out there in Australia, New Zealand, other areas, speak up because this is going on. You've seen the euphoria. People are going crazy right now with real estate, and they're sucking out that equity that they've built up in there because of all the pandemonium which is happening, and it's going to hurt them even more. This is a huge mistake that people are making, and unfortunately, they're going to have to pay the price. Overall, nearly 1/4, 24% of Canadian homeowners polled said they haven't been able to come up with enough money to pay a bill in the past year. 1/4 of people. And these are the same homeowners that will suffer should prices increase or interest rates increase by 1%. Now, day one, if they increase mortgage rates by 1%, what's going to happen? Nothing. But inevitably, people have to refinance. And a lot of these people are, in fact, on variable mortgages. It will hurt them. There's a lot of people on the ARMs, adjustable rate mortgages. This, people suggest that, I'll just move my money out, I'll go to a fixed. But it's quickly going to be a problem for people. And even if they do get a fixed mortgage, 3 years, 5 years, it's going to have to happen. The mortgage rates probably aren't going to go down anytime soon should they decide to increase them. Or we could take the devil's advocate approach, and if they do in fact decrease them, the bubble will continue. And we know how that hurts in the long term. Overall, this is that the same piece of information, but over half of those polled had $5,000 or less set aside to deal with a financial emergency, while 1/5 of them have nothing saved for a rainy day. It really shows you that when we have this problem, sooner or later interest rates are going to rise. It's a matter of fact. We are going to have this big problem. It's coming. The waves are crashing in. Here it is. When? I don't know. You ask the central bankers when they're going to decide to increase mortgage rates. Ask those CEOs of all the big banks when they're going to decide to do it. When it happens, here comes a crash. And this is another chart here, basically just showing you chart form what I was talking about. The percentage at which this increase will cause a problem for people, and it doesn't take much. That's what the chart's basically saying. A small increase will hurt people. And then last but not least, the number of uninsured mortgages is on the rise in Canada, and the new risks are emerging alongside these loans. That's according to none other than the Bank of Canada. They like to pass on the pain, pass on the sort of the blame to each other. The mortgage rates are at a historic low, and they say that we're doing this. Look, the rates at which the Bank of Canada have are very low, so we're passing on the savings to you. But then the Bank of Canada says, look, your mortgage rates are so low that you are fueling a bubble. So they just pass it back and forth, hot potato. The stats in here, you can read it for yourself if you're interested. It's very clear what's happened. Too much of a bubble, too low interest rates, people are overextending themselves, they're in the highest amount of debt ever, eventually it's going to have to pop, eventually this bubble will destroy a lot of people, but if we increase interest rates, we are going to cause it. So we are in a dilemma like no other. And that's why I believe that they've kept them this low for this long. They're not sure what to do. The policy would be to increase rates a few years ago. But politically, that's really bad because an increase in interest rates allows this bubble to fuel. People pull the money out, they buy cars, they go to the restaurants, they buy this and that. I see this to become, quite frankly, one of the biggest crises that Canada will see. I think it's going to be a lot worse than what was seen in the early 90s. But the question is what they're going to do about it. It's inevitable, however. If you found this video informative, please give me a thumbs up. If you hate it, give me a thumbs down. If you don't like my face, give me a thumbs down. If you think that Janet Yellen is wonderful, then give me a thumbs down. Just give me a thumbs down just for fun. And last but not least, if you found this video informative, I know you will find my books, The Money GPS, and my new release, Global Economic Collapse, even more informative. If you're interested in real estate and really breaking it down, what it all means, these rates that I've talked about, everything else, then that's in my first book. If you want to know the relatively similar issues, but then getting into how to reduce your monthly expenses, becoming self-sufficient, and those type of topics, that's in my new book, Global Economic Collapse. So while they do have some familiarity, there is sort of different topics. So check those out at Amazon. The links are in the description below. Take care.